Hi there, welcome to Nappy Invest. Inflation, it's been in the news a lot lately, particularly in around about the May the 12th or 11th when the United States released their CPI numbers or figures for April, and they were actually higher than expected. And when you do see inflation higher than expected, that does cause a few ripples in the stock market. And we saw on the day, believe the NASDAQ went down something like 3% because NASDAQ is filled with growth stocks. And when you have inflation being higher than expected, the fear is interest rates will rise sooner than expected. Interest rates rising are the natural enemy of non-profitable tech stocks, and that's why they took a massive hit on the day. And then, in fact, that's why tech stocks have taken a massive hit over the last few months, is that the expectations that inflation will rise, that interest rates will rise sooner than expected or sooner than the plan from the Reserve Banks. That's why we're seeing tech stocks under pressure over the past few months. Now, this news of inflation shouldn't be a surprise to many of us if you do a bit of reading. Now, if you do read a lot of company reports, you'll find that a few companies have mentioned about these inflationary pressures on their business. And I'll give you three examples of ASX companies that have released news within the past month about these pressures. If you just listen to Berkshire Hathaway's AGM 2 weeks ago, Warren Buffett mentioned about these inflationary pressures on the companies that Berkshire Hathaway owns. So this inflationary news shouldn't be a surprise. The big question moving forward is whether this is transitory or if it's long term. The Reserve Banks, the Fed and the RBA both believe this is just transitory and we'll see inflation just give a bit of a bump in the short term and then come back. But if it is more of a long-term issue, that's where we will see issues moving forward. And more than likely, if it is long-term, we will see stock market correction, particularly in those high-growth companies that are not profitable. They will come back a fair bit. So in this video, I'm going to talk about the motivation behind me doing this video. I did get quite a few questions in the past week about inflation and about how I might change my philosophy or my strategy. So I'll talk about that, talk about those two questions. I'll answer the questions I received towards the end of this video. Before I answer those questions, I'm just going to look at the macroeconomics and should we as investors care about macroeconomic issues. I have heard quite a few people talk about how, as individual investors, we shouldn't care about the macroeconomic factors. And they always bring up Warren Buffett doesn't care, so we shouldn't care. I actually disagree with that. Warren Buffett does care. What he doesn't care about is economic forecasts. And I absolutely agree with him. Economic forecasts are almost absolutely useless. Also talk about inflation and why we should care about inflation as investors. Because deflation is bad, high inflation is bad. So there is a compromise between those two, a sweet spot, as you could say, for investors. I'll talk about that as well. And then I'll talk about why I have been getting questions and why inflation has been in the news. So let's get stuck into it and look at the motivation behind this video. The main motivating force for me during this video was in regards to questions from some viewers. And if I get quite a few questions about a particular topic, I will address those questions in the video. So just keep that in mind. If you do have a question, and I do get a lot of questions, I actually will do a video on it. So I did receive two questions from Health and Mysterion last week in regards to inflation, excessive inflation, or current inflation fears. So I'll answer those comments or questions towards the end of this video. I've also received another question from Pifeng Wu, and I'll address that comment individually in the comment section. So I actually won't address that in this video. So before I talk about interest rate of inflation, I'm just going to focus on macroeconomics and whether we should be concerned about macroeconomic issues. Over the years, the past decade or so, I've heard a lot of people, individual investors and experts alike, mention how they don't care about macroeconomic issues. All they care about is buying high quality companies whose share price will be significantly higher in 10, 15, 20 years. And so they completely ignore any concerns about inflation, any concerns about interest rates, any concerns about any sort of macroeconomic issues. I do believe that's a mistake, because every single company in the world, every single company on the stock market is going to be affected by macroeconomic issues. Now, just take, for example, a long-term holder who buys a tech company that is not profitable. It might be a better company in 5, 10, 15 years, but they have had significant tailwinds behind them over the past decade with continually lowering interest rates. And as we get lowering interest rates, the value of the company actually increases just because of the lowering interest rates, no other reason. So if we start to see interest rates rise, the company's valuation will be negatively affected, and we might see the share price take a massive hit because of that. And if you keep your head in the sands around the macroeconomic issues that can affect individual companies you own, that could harm your returns in the long term. So I do believe it is a mistake to be completely ignorant about how macroeconomic issues can affect every company you own. Now, I have 3 examples here in regards to companies who have released how some of these macroeconomic issues are affecting their company, neutrally or negatively. So the first one was on the 23rd of April. Kogan released the first mention of inflation I saw in an ASX announcement. So they have observed price inflation for many of their products, particularly those who have silicon chips and LCD panels, and they've also noticed inflation in international shipping costs. So this was the first mention of inflation I'd heard in an ASX announcement. Then 4 days later, 4 days, I saw another announcement from a company, Reliance Worldwide Corporation, who mentioned of sustained input cost increases, which means they're going to implement price rises for their product. So they have pricing power. And this is very important, whether a company you own has pricing power or not when they see sustained input cost increases. So Reliance were able to pass the input cost increases onto the consumer. So that is inflation. So if a company you own doesn't have that pricing power, that company's margins will be hit, and they'll have lower profits, lower free cash flow, lower operating cash flow, and the company will be negatively affected by that. So we have been seeing this recently in sustained input cost increases. So with Reliance, it was all about higher copper and zinc prices. And again, Warren Buffett has mentioned that Berkshire Hathaway's companies that they own have been experiencing the same thing. So companies are experiencing this right now. So it's very important to know if a company you own has pricing power or not. And then on the 13th of May, Parenti announced that I think it was a profit downgrade, and they are experiencing some issues in regards to COVID-19, currency issues as well. But one of the main issues they mentioned was a tightening in the labor market. So this isn't really directly in regards to inflation, but this is a macroeconomic issue, and this is affecting the performance of the company, not only this financial year, but they've also mentioned it might last into next financial year as well. So this increase in demand for domestic labor, so this is all about demand supply. So increasing demand, and if supply remains neutral or even goes backward, if you get high demand, lower supply, that means wages have to rise. So this could be the start of a wage growth or wage rise growth, which is very important, because if we do start seeing wages rise throughout the community, so we might be seeing it in the mining industry, this could put pressure on inflation, and this could mean that inflation is not transitory. So they just mentioned that this increasing wages is affecting their margins. So very important to understand how macroeconomic issues may affect individual companies you own. Interestingly enough, over the years, I've heard quite a few people say that Warren Buffett doesn't care about macroeconomic issues, so why should we? And they use that as a reasoning behind their indifference or keeping their heads in the sand when it comes to macroeconomic factors. Now, that's a complete fallacy. And here is a quote from Warren Buffett in 2016, talking about how they're interested in economic and political matters, and they know a lot about macroeconomic factors. But what they're saying is when they see economic forecasts, they ignore that because economic forecasts are hard and can be wrong a lot. And if you make decisions based off economic forecasts, you could be heading down the wrong path. And I absolutely 100% agree with that. Even though we are seeing some information about inflationary pressures, it doesn't mean this is a long-term thing. The RBA and the Fed could be right. This could be just transitory. But on the flip side, the RBA and the Fed could be wrong. Maybe it's not transitory. Maybe this is going to be a long-term issue. And then on the flip side there, if you go to Stephen Van Meter, who is a deflationist, he has a YouTube channel. I do believe you should get all sides of the story. And I love looking at Stephen Van Meter's videos because he's a die-hard inflationist. He believes we are heading for a deflationary period. So who knows who's going to be right? I don't know. So I am not going to make investing decisions based off these economic forecasts. We could be heading for deflation. We could be heading for hyperinflation. And until I get more information, I won't make investing decisions based off that. So I won't be heading towards 100% gold. I won't be heading towards 100% cash, like seems like Phil Town is heading towards based off one of his videos recently or his podcast recently. I don't know. All I have is information right now on hand. For example, those three announcements from Kogan, Reliance, and Parenti. That's all the information I have. But I still don't know if we are heading for high inflation or if it's just transitory. In saying all that, I don't know whether we're going to go to deflation or high inflation. All I do know is both deflation and high inflation is bad. There is a sweet spot in between that central banks, including the RBA, are trying to target, and that is inflation between 2 and 3%. So why is deflation bad? Just think of consumer spending. If you know prices are going to be lower in the future, you won't spend. So there's a lot of delayed spending when it comes to consumerism, and governments hate that. They want people to spend. It stimulates the economy. So that's the main reason why deflation is bad. It also increases the real value of debt. Unemployment increases, wages decrease. In fact, you might say the biggest fear for governments and central banks is deflation compared to high inflation because they think that's more likely right now. So why is high inflation bad? Well, you got increased borrowing costs, for instance, increase in input costs, materials, labor, and we've seen that in those announcements from Reliance, Kogan, and even Parenti, increase in labor costs. So that should actually give you a clue that maybe we are heading for a period of high inflation if this is not transitory. Also, standard of living decreases and the prospect of interest rates rising. And that will have an effect on the stock market, particularly those high growth stocks that are not profitable. So the government is targeting a 2 to 3% inflation rate. And the reason they're targeting that is it does not distort economic decisions in the community. So this is straight from the RBA website. They do have an inflation target. There's also research out there that suggests the highest real returns in equities or the stock market happen in that sweet spot between 2 and 3% inflation. And right now, with the CPI announcement from the United States last week on the 12th or 11th of May, inflation is now at 4.2%. It is now above that sweet spot. Inflation has been in the news over the past 3 or 4 months. The main reason it's been in the news is because of rising bond yields. Rising bond yields means expectations are that interest rates will rise. If interest rates are expected to rise in the next 3 years, that means inflation should rise along with it. But only in the past week, we did see inflation come to the forefront of the news cycle. And it was all because when the US released the CPI numbers for April, the month-on-month increases, we did get a lot of, well, I won't say excitement, but we did see the NASDAQ drop 3%, and we did see it become front page news across the world, maybe. Anyway, so the whole reason this was newsworthy wasn't because of the actual number, which was 0.8%. It was the fact that the forecast CPI was 0.2. So you could say it was quadruple the forecast. In fact, I did read some news articles before the release of these numbers, and these news articles was focused on the fact that expectations were that inflation was going to actually decrease from the previous month. So in March, inflation was, or CPI was 0.6%. So instead of decreasing, we actually saw an increase. And that's why this was in the news. It wasn't the actual number, it was that the forecasts from the economists were blown out of the water. And in fact, over the past 10 to 12 months, we've seen actually month-on-month CPI numbers be quite high, and that translates into high annual inflation numbers, which I'll get into in the next slide. And here we do have the annual inflation. So this is a rolling number, which is updated every single month when we get the month-on-month CPI numbers. And right now, April 2021, it's at 4.2%, which is higher than that sweet spot between 2 and 3%. It is the highest since September 2008, which is sort of right smack dab middle in the GFC, or just before the really bad parts of the GFC were just about to happen. I think it was October 2008. And the biggest increases were in energy, so petroleum, fuel oil, and used cars and trucks, which is not a surprise to me because I've heard a lot of anecdotal evidence, which doesn't really mean it's real evidence, but a lot of anecdotal evidence that the used car market right now is in a frenzy in Australia. In fact, I heard one story where someone could have got a job at a new car dealership with BMW, instead went for a used car position because that's where all the action is happening right now. I think the main reason behind that is because people are having a hard time buying new cars. In fact, it's something like a 4 to 5 month waiting period to get a new car. So instead of waiting, they'll just buy a used car. So if you do have a car you want to sell, now's the time to do it. Now to answering some of the questions. In health, they wanted to know my opinion on the potential for excessive inflation occurring in the near future, and as a result, interest rate rises and possible share market pullback. I believe the last part of that question is very important on whether what we're experiencing now is transitory or long term. The Fed and Reserve Bank, and probably many other central banks, is betting that this period of inflation is transitory, not long term. And if it was long-term inflation, they would be raising interest rates right now. And they're not doing that. So they are betting on that. And we know they are betting on this simply because they've said it. And this is from the Fed Vice Chair Richard Clarida, only transitory effects on underlying inflation. But they could be wrong. They could be right, they could be wrong. Now, there is a bit of validity about their beliefs because it could be just based off supply and demand, and there is a bit of supply pressures. And once the supply comes back online, we won't have those pressures and we won't see this inflation being long term. However, a few of the announcements we've seen from companies have mentioned this is sustained pressures. These supply issues, input costs, have been sustained. We also saw Parenti mention that they expect this tightening labour market to continue into the next financial year. So there is potential that the Fed and Reserve Bank are going to be wrong. And if they are wrong, there's going to be serious issues. And this is why there are going to be serious issues. So if we have high inflation, the first thing we'll see is interest rates rising. And the bond market is expecting this because we're seeing increasing bond yields. But even the bond market could be wrong. Maybe they're being a little bit too optimistic, not pessimistic enough. So interest rates rise means the share market will pull back, particularly those high growth, non-profitable companies. And I'll talk about why in the next few slides, but it's all based off the present value of future cash flows. In a high interest rates environment, the present value of all these non-profitable companies' future cash flows is considerably lower than in a low interest rate environment. So in this sort of environment, the best sort of companies to own will be value over growth. Next question is also from Health, and it's what's your plans for particular stocks to invest in, or if you just follow the same mentality of finding stocks that are breaking out and undervalued? Well, simply enough, I don't change my strategy at all. In fact, I find my strategy adapts to what's happening in the broader economy, in the stock market. So I've sold out quite a few tech stocks over the past 5 or 6 months, and I bought into commodity stocks, bought into value. Now, if we do see the market go into a correction, I might go towards cash, because that's what the strategy tells me. Go towards cash. Sell these companies that are in downtrend. And I do believe that's one of the benefits of this strategy, that you listen to what the market is telling you. Go to cash when you have to, and then go all in when the stock market recovers. Final question is from Mysterian. In fact, it's more of a suggestion or a comment than a question. Would love a video on your opinion of current inflation fears and the effects it may have on growth tech stocks. Well, funnily enough, I did a video on this about 2 months ago on March 9, 2021, titled Why Are Technology Stocks Crashing? So at that point in time, we had 10-year bond yields rising quite quickly. And if 10-year bond yields are rising quickly, the bond market is expecting interest rates to rise, and there is a link between interest rates and inflation, as I've already discussed in this video. Now, towards the end of this video I did on the March 9, I had this slide on DCF. So DCF is discounted cash flow. And this is how a lot of people value companies. They look at, or they try to value the future cash flows. And if you have high interest rates or high interest rates, you will see the values of your high growth stocks be considerably lower. And I just used this example in that video with a discount rate 2% versus 5%. The best way to look at the discount rate is the interest rate. And if you have a discount or interest rate of 2%, the stock value per share for a company with earnings per share of $1, growing at 10% annually for 5 years, and then 1% after that, the value of that company is $153.63. If interest rates go up to 5%, the value of that company is only $37.62. So you can just see the impact of high interest rates on the value of high growing tech companies. And that's why in a higher interest rate environment, those growth companies will be significantly affected by those high interest rates, particularly those non-profitable companies, because those non-profitable companies have all their cash flows 5-10 years in the future. And if you calculate the present value of those future cash flows 10 years in the future, those present value of those cash flows are considerably less in a high interest rate environment. That is all I've got for this video on inflation and investing. If you have any questions about anything I've had to say in this video, or you just want some clarification, make sure you leave it in the comment section and I'll answer anything you have to say ASAP. My throat is getting quite dry now. I need a bit of a drink. So last thing I should say is I'm not an investment advisor. So if you do need some advice about your own investing life, make sure you seek out someone who is qualified and can speak to your own individual needs. That's all for this video. Have a good day. Bye.